Okay, I see folks coming in. Excellent. All right. So welcome everyone, and thank you for taking the time to join us, to join the conference board for already the next webcast here. We're increasing the rate actually of these things because we're seeing that people appreciate them. So I'm sure this is going to be the case for this webcast as well. Interesting topic, very hot. I had a meeting this morning and we talked about exactly the same thing. And I know some of you who are in the morning's meeting will be joining this session as well. Innovation accounting, how to measure, value, and manage the intangible. My name is John Metzler, and I work with the conference board to guide you through this. Let me see here. How do I move the slide? Okay, here's the button. Before we move into the subject, I just wanted to go and get some housekeeping rules out of the way. We want to make this as interactive as we can. Don't hold back. And it's easy because you can just put your questions in the chat box that you can easily find in your interface. So no need to raise your hand or get exposed. You can very discreetly pose your questions. The presentations, the speakers today have been friendly enough to make the presentation available, so you can download that already right now. You can find the button as well. So go ahead if you prefer that. Full screen, you can toggle on the top right, full screen and smaller. And then also, within 24 hours, we'll be making this webcast available for you to watch on demand. It could be interesting if you like what you're seeing. You can share this with everybody that you want. It's a complimentary webcast with your colleagues, with your friends. Put a link on LinkedIn or any other social media. By all means, don't hold back and share the good news. Credits, I want to mention you can earn credits. You do need to stay online for the entire webcast. It's only available for you that are attending the live webcast, not for those that are watching the on-demand one later on. Make sure you type your full name, your email address, and then specify the CPE or the CPD in the space provided. And then pay attention. You don't want to miss one of the 3 pop-ups that are going to be suddenly appearing. So it requires you to be not only watching this, but also in an attentive way. And then I want to introduce the speakers. I already mentioned myself at the bottom. I lead the conference board. I co-lead it with Rita Shore, the Institute in Digital Transformation for the conference board. And I also manage the European Innovation Council. And then I do a whole bunch of other stuff, which I don't want to bore you with. And I'm happy to, it's an honor and thrill to introduce Jim Gregory, who is a senior fellow at the conference board, and you can find more of his bio shortly here, and then also when you downloaded it in the attachment. He is the chairman and emeritus of Tenet Partners, and he's pioneered the development of the CoreBrand index, which allows a key element to go and have us measure the intangibles. So, and he's going to introduce this in this session to us. He's going to take a macro view of the intangible and how to manage innovation, how to measure, how to value, and how to manage innovation. Then Thomas is going to come in and he's going to go and take a micro, an internal view on how do you do this within a company. Dan is the founder of Outcome. He helps large companies transform and run their core business in a better way. He also dual MBA degree. My God, Dan, you're the first one I've ever met who's got a dual MBA degree. He also co-authored this outstanding book, which is my MBA class, guiding light, corporate startup, and it was justifiably so awarded the 2018 Management Book of the Year. So also a plug of if you don't have this yet, you may use this reference work for your benefit. So Dan and Jim, pleasure to have you with us, and I look very much forward to hear you talk and have you start the conversation to go and get a handle on those intangibles. And definitely when it comes to ultimately managing innovation within a corporation, which is a huge priority and a huge challenge in many of the corporations. With that, I want to hand it over to Jim, who's going to kick us off with a macro view, and there's going to be some really interesting stuff in here. So Jim, up to you. Thank you for joining us again.
Okay, sorry, my microphone was muted. So today I'm going to talk a little bit about the macro view, and this is an overview of the work that we've been doing for over 30 years. It is called The Theory of Intangible Capital, and it's about managing assets for value creation. Intangible assets are valuable, but they tend to reside in intangible silos. Today, they're unaccounted assets with no accountability. What I've been working on is a concept called intangible capital. And that's a management tool that provides accountability without changing generally accepted accounting principles. The reason this is relevant to you is because intangible assets have grown exponentially over the recent decades. In 1975, they were only accounted for about 17% of the total value of the, as a component of the S&P 500 market value. In 2015, they were closer to 84%, and today I would guess it's closer to 90%. I mean, it's incredible growth over a relatively short period of time, and it's something that should be paid attention to. This slide was provided by Ocean Tomo with their permission. The definition of intangible assets are that they vary widely, but they have no physical form. And these are some of the intangible silos that I'm talking about. They could be marketing related, they can be customer related, they can be artistic, technology based, or contract based. But these are all intangible silos. And when a company merges or is acquired, these intangible silos are valued as part of the acquisition process. But it's a very cumbersome process, so it makes a continuous evaluation kind of hard to do and expensive. What we found is if you quantitatively measure descriptive attributes that describe these different things, you have a very reliable and consistent measure over time. There are things that we measure like overall reputation, or perceptions of management, or investment potential, and more recently, a culture of innovation. And what we're finding is that has become a very reliable, consistent way of looking at intangible assets. Professor Damodaran of Stern, NYU Stern, has written widely on the subject, and I like his explanation of how intangibles have evolved. During the industrial age, excuse me, most companies were based on physical assets. GM and Standard Oil owned land, buildings, factories, etc. And so it was fairly easy to identify where the value existed in the companies. Consumer brands tended to change all of that, and as consumer brands like Coca-Cola evolved, they had trade secrets, valuable patents, brands, which became harder to value. But even when more than half of the company, the consumer products companies, can be explained by the brand name alone. The computer age and the information age have pushed that change, that evolution, even further. And so companies like Microsoft and Apple have technology and intellectual property that was highly valuable, but mostly intangible and very difficult to value. So this leads to a dilemma. Traditional accounting rules basically ignore internally grown intangible assets. They're not on the balance sheet, and they show no evidence of them. The costs associated with building the value of it is very difficult because there's no connection to return on investment. They're only seen as expenses and not investments in the company. So this always becomes a dilemma between the communications people and the CFO. There's always a battle for budgets, and they're really not asking the right questions. They're fighting over the crumbs on the table rather than seeing the big picture of value. And Damodaran also said that the market value of these companies come from their intangible assets, but there's no system to consistently manage them. So he concluded that the failure to value intangible assets distorts all kinds of market measures, such as price earnings ratios and the EBITDA. It also distorts profitability and return on equity. So it's a very important and fundamental issue that should be dealt with. Even acquired assets, which are on the balance sheet as goodwill, is a kind of a haphazard solution. In this case, values can go down, but not increase in value. So once they're on the books as goodwill, they can only be written down. And what happens is that really throws off the purpose of acquiring assets. Kraft Heinz was written down, 15.4 billion was written down in 2019. Coty lost $3 billion of their brand assets, and P&G lost $8 billion in a write-down of their Gillette brand assets. Well, you think perhaps that might have been a marketing problem or an issue with their brands, but the fact is that P&G didn't write the value of how Gillette helped improve the bottom line value of the parent company over that same period of time. So there's a real disconnect, a fundamental disconnect between value and accountability. And I like to summarize it with this slide to sum up the problem. Internally grown assets, intangible assets, don't exist on the balance sheet according to generally accepted accounting principles. And even intangible assets that are acquired can only go down and not up. So it seems a bit like this fence standing in the middle of the field, and the accountants are focused on how many animals go through that fence and not the ones that go around the side. Now, in fairness to accountants, I think they're doing their job. They have their rules and they follow their rules, and those rules are very important for overall accountability and for the financial markets. But to not account for intangible assets in any way creates such a huge dilemma and an unfair dilemma for every organization. Now, as I said, I've been focused on this since 1990. We originally did this project for GE. A gentleman by the name of Richard Costello made the request, and he asked, is there a way that we can prove the value of what we're doing when we're building corporate campaigns and promoting the overall GE brand? Is there any way that I can prove that so I can go into Jack Welch and say, here's the value that we're actually creating? So we developed a study that is a quantitative research study of impartial observers. These impartial observers are both business leaders as well as great consumers. We do 8,000 phone interviews per year, and these are completed interviews. And we measure familiarity and favorability attributes based on a 1 to 4 point scale. Now, the favorability attributes that we measure are overall reputation, perception of management, investment potential, and a culture of innovation. The culture of innovation one is a more recent contribution to those intangible assets. And it was making that new intangible attribute that we were measuring that really helped us see that it was much more than the corporate brand that we were talking about. But we found that these descriptive attributes represented many different intangibles. Maybe not all the intangible assets, but it's well on its way to identifying most intangible assets and how they create value. So if you have a consistent model of research to be able to understand how these intangibles are growing or declining in weight, you're able to apply it to financial models. And there are two financial aspects that you're trying to achieve with any kind of branding effort or any kind of effort to build your intangibles. One is you'd like your products to be at a premium price. you want to beat the competition in terms of being able to put a higher price on your products. And the second is the premium pricing of stock price. And this is the one that I've been primarily focused on over these years because I find it a much more manageable and easy way to identify the value creation. And we do this through the cash flow multiple. And if you're not familiar with the cash flow multiple, it allows for an apples to apples comparison between different size companies. And you're able to identify the premium value that an investor is willing to pay given a company's level of cash flow. Now, an example of this is the cash flow per share of $10 per share with a stock price of $20 per share, and that would be a cash flow multiple of 2. Now I'm going to give you an actual example of that, taking on comparing two companies in one industry and looking at the cash flow multiple of Tesla, which last week was at 104. It has since gone up. And Ford, which is at a cash flow multiple of 0.56. Now, you can clearly see a huge difference here. They're both in the same company. They both actually, are producing cars, but one has an intangible asset that is very vital and growing and creating value for the company, and the other one is not. Now, this is the model that we've been using for budgeting and accountability purposes. To explain it from right to left, the cash flow multiple is always the dependent variable. And the financial variables are the independent variables that examine the total value of the company. So we look at everything. We look at sales, revenue, cash flow, earnings growth, expected cash flow growth. And having all that information, you can not only look at the present, but what is projected into the future. Now, the independent variables on the far left are the attributes that we measure. And these are independent variables, and they're the control inputs. So in the case of the Ford and Tesla, I would say that Tesla not only has a good reputation, but they're perceived as strong management, huge investment potential, and they have a tremendous culture of innovation. Plus, they're very well known. So they have just about everything going for them. If you think about Ford, Ford has familiarity. Everybody knows the Ford Motor Company. It has had a reputation issue for many, many decades, but the perception of management has always been fairly strong. The investment potential is significant, but it is not always on top of things. And the culture of innovation, it used to have a tremendous culture of innovation, maybe not so much anymore. So you can have these tools that you can identify and manipulate to see how they might impact the financial variables and ultimately the cash flow multiple. And the clever thing is you can project these out into the future and be able to hold yourself accountable quarter after quarter to see if these attributes and grow in value. The CoreBrand equity value, this is also taken last week. Intel was over 40 billion. Ralph Lauren is over $1 billion. Nike was 27 billion and a half billion, and PepsiCo is 36 billion. These are figures from last week. So to have an ongoing running brand equity value is very consistent and reliable. And boards have a fiduciary responsibility to manage all their assets, and these intangible assets are material, and they should be managed as well. So just to recap, the theory of intangible capital is about managing intangible assets for value creation. Today, these assets are unaccounted assets with no accountability, and intangible capital is a concept that is proven over time. It's a management tool that provides accountability without changing generally accepted accounting principles. A few key takeaways. Intangible assets are material to the company. They can be managed, measured, valued, and managed for value creation. Intangible capital works for budgeting and managing as a management tool for accountability. And it doesn't change generally accepted accounting principles. It's simply a management tool. So it also creates alignment of goals between management and accounting. So I have been working with John for a number of years now, and the concept that I've been working on is making intangibles tangible. And I would be happy to work with anybody, answer any questions about this issue. We can certainly check to see if your companies are part of the CoreBrand Index and how that might be applied to your needs. Later today, Hampton Bridwell, who owns the CoreBrand Index right now, is going to be doing another webcast with John Chambers, who was a 15-year client of CoreBrand, my company. So it's kind of neat. They're going to be speaking on a later webcast today. Thank you.
It was before even, Jim, but it doesn't matter. So hey, yeah, I mean, fascinating. I have a few questions, but I want to give credit to the audience. There comes, quite a few questions coming in. Dennis O'Sullivan, hi Dennis. Why a multiple of cash flow, Jim, rather than profit, or would you look at some combination of it? I think you mentioned.
We look at all the financial variables, and the cash flow multiple allows for an apples to apples comparison. That's the one that allows us. It's very consistent. If you begin to, certainly when we're working with specific clients, we look at profit. We look at every aspect of their financial performance. But as a quick measure, as having the ability to quickly and inexpensively put together a program to examine these intangibles long term, the cash flow multiple has proven itself over and over. John, I can't hear
Andre, you. Ursanov is asking a question. Difficult to read, Andre. Let me try. In a way, tangible assets are about the same difficult to evaluate as intangible in contemporary economics, where the value is where supply meets demand. If market is ready to pay 20K per intangible Bitcoin or a piece of tangible wood, this is the price today. Market perception, temperature changed, and tomorrow the value may become totally different, isn't it? Jim, now you are on mute.
I think you're crossing over between the premium value on the product versus the premium value on the stock price. You're right. I mean, I pay a premium price to have an Apple computer. I also own Apple stock. A Tesla. I don't own a Tesla, but the value of that stock is undeniable. How it's taken off, but it's beyond logic, and so that there's, I'm afraid it's going to almost be like tulip bulbs, and it's almost that irrational. You need to to have a systematic way of examining these and being able to analyze, what is actually driving that value, and information is everything. To be able to understand what is driving that value and to be able to manage it to some degree.
I think that makes sense, at least to me. But I'm not. I'm an innovation guy, not so much a finance one. But Andre says thank you, so I guess that answers the question, and indeed it makes sense to me. Hey, also a good one, Antonio Urquiza, sorry if I pronounced that wrong. Jim, hi. Is there any discussion ongoing with respect to mandatory disclosure of the index, either via SEC filings or another channel, which indeed was also a question to my mind. This is so instrumental to so much value in the market that the fact that we only measure tangibly 10% short of the work that you are doing. What's your perspective on that?
We have been well aware of the SEC and the rules of the SEC, and it's always been part of the of our consideration in building this. It has. I have no doubt at all that the SEC would be involved as if this had a large distribution. If everyone was using it, I think it would become a tool that would need to be fully disclosed. I think that intangible assets should be disclosed on the financials of a company in the notes portion of the financials. It's easy to do. It's relatively inexpensive to do, and it should be in there. But since people, companies don't fully understand their intangible assets, it hasn't become an issue with the SEC. It will someday if this.
Thank you, Jim, and thanks for your questions. This is a nice segue into moving on, and we've now seen the incredible relevance and importance and impact of intangibles at a macro level, at an economic level, and innovation is an important part of that, right? More and more so as we're living in VUCA world and super VUCA times with VUCA on steroids in the COVID era. And so how do you then manage that innovation part of those intangibles within a company? And that allows me to hand over to Dan, who's going to provide us with all the answers that we can, all the dust magically clear up, and from now on we'll know how to manage innovation in a company.
Thank you very much, John. Yeah.
Take it away.
Thank you very much, and thank you very much, Jim. That was a great presentation, and I'm sure I'm going to include a lot of that into an upcoming work on corporate innovation accounting. Before I jump into that, I wanna echo some of the things that Jim told us through a very interesting story. And at the bottom of this slide, you can actually see the conclusion of the story. The story revolves around the creation of ASUS. So a lot of people probably are seeing this webcast on an ASUS laptop, or at least they've owned an ASUS laptop at one point in their life. I know I did. But basically, the story goes like this. ASUS, before it became a laptop manufacturer, was a supplier of parts for Dell. And I'm sure a lot of you know Dell. They initially provided Dell computers with the motherboards, and then they started providing them with the hard drives as well. This was a very lucrative business for both sides. ASUS, on one hand, obviously was getting a big volume of orders for their parts from Dell, and Dell was having a good time with ASUS because they no longer needed assets on their books, such as, for example, manufacturing facilities in the US to produce the hard drives or the motherboards. And they would still be able to sell the end product at a premium. At one point, the executives in Dell said, okay, let's outsource more and more of our computer to ASUS. So from just providing Dell with the motherboards and the hard drives, ASUS at one point started providing Dell with the video chips, with the memory cards, pretty much with the entire laptop. The partnership went that far to the extent that at one point ASUS was managing even the marketing and the sales pipeline and the sales contracts of Dell in the US. So they had direct access to Best Buy, they had direct access to other retailers in the US. Obviously, this was very good for Dell because Dell was able to write off a lot of the assets from their books. However, their share, their revenue stayed the same, and obviously the RONA, the return on net asset, went through the roof because obviously with the same number of dollars coming in, if you just divide it by a small number of assets, obviously that number goes up, the RONA goes up. At one point, ASUS said, okay, since we know now how to build a laptop, we know how to design a laptop, we know how to market and sell one, why don't we build our own? And this is how actually the ASUS brand was created. It was actually created by Dell. This story comes to tell us that as a manager, as an executive, if you overemphasize the financial metrics at the expense of all the other metrics, in particular the value creation process metrics, you will be most likely going to make some management mistakes. Some of them might be tactical mistakes, but some of them might be strategic mistakes, like in the case of Dell, that actually created a new competitor just because they were I would use the word greedy now, just because they were influenced by financial metrics. Moving on, this comes to show the fact that we have three major conundrums when it comes to measuring the company's performance, and in particular measuring a company's performance solely through the lens of financial metrics. First of all, the most valuable asset of a company are not accounting recognized, and this is what Jim has so eloquently told us so far. There are only a few organizations in the world that have their most valuable assets on their books. And here I am not joking. I'm looking at football clubs, professional football clubs like Real Madrid, like Barcelona, like Arsenal. They have their players as part of their they are on their books written as assets. So they are actually the only company that properly treats people like their assets, not just the HR tagline. The second important conundrum is the fact that accounting-based financial reports show the final outcome of an asset being deployed, that is revenue or earnings. Financial-based reports don't tell us anything about how a certain product was created, how a certain process works. They only tell us if that's profitable or not. And if we're only going to run our companies based on financial reports, we might run the risk of doing what folks in Dell did. Now, the last one, which is actually this one speaks to me on a personal level because I come from product development. The accounting system can't measure something that hasn't happened. And with a lot of companies using methodologies such as lean manufacturing, we'll talk about manufacturing, and lean startup and agile development and design thinking, when you talk about developing new products, well, a big part of what the lean startup methodology is telling us that we need to avoid risk. We are de-risking our ventures every step of the way. So what we're actually doing, we're preventing failures from happening. However, the accounting system cannot track the fact that you've prevented a major disaster in a certain product. The accounting system cannot put a dollar sign on the interviews that my team has done and that helped us shape the value proposition for that particular product. And this is why we actually need to come up with a new accounting system. I refer to it as innovation accounting. I was not the one that coined the term. I think Eric Ries in the corporate startup was the first one to coin this term. But the need is today stronger than ever because a lot of companies now realize that, hey, we need to actually supercharge our innovation efforts in order to survive in the future. It's easier said than done. I will explain to you how the system works, but now I want to take a macro view of an internals of a company. So basically, in the corporate startup, we say, well, for a company to work, for an innovation ecosystem to work, it needs to have a strategy, it needs to have innovation management, and then you need to put everything in practice. Essentially, how this works is that in your innovation strategy, you create the vision for the future, you start putting it into practice by investing in ventures, be it internal ventures or external ventures through your corporate venture capital arm. These ventures go to the market, they try to sell, they try to validate, they try to learn, and you are actually getting feedback from the market for your innovation management system. And this is immediately communicating the lessons learned and informing the next iteration of the strategy. If the ventures that were based on a certain strategy didn't work in the market, it means that the strategy was probably faulty. And a lot of the things that the company said they should be doing they should probably, for the next iteration of their strategy cycle, move those things to the things they won't be doing. Now, in terms of innovation accounting is part of management, as you can see here, but it actually acts on all layers of the organization. So it is part of management, but it's also connected to the innovation strategy. You have global KPIs, but it's also connected to how teams are managed. So very, very tactical. I've created this pyramid to explain this concept a bit. You have at the bottom the culture and capability. I'm not going to mention that because I think Jim did a very good job explaining the fact that innovation culture should be measured because it's a very important asset for a company. On top of that, you have reporting KPIs. Basically, how do we measure teams, right? And then we take that information about how we measure team, and then we look one layer up and we say, okay, how do we measure our entire pipeline of ventures? How do we take decisions like venture capital companies do? And then at the top we have the global or the corporate-wide KPIs. This is where we're learning about our strategy. We're learning our overall performance of our internal innovation ecosystem. Do we have the right strategy? Do we have the right elements? Are the elements of our ecosystem working in sync? These are all the questions at global. Now, in the following slides, I will talk to you specifically about every layer and give you an example of what are some metrics you can implement there. But before we do that, I want to clarify two things. I want to clarify the principles of an innovation accounting system and then the difference between KPIs and KRIs. For the principles, we say that every company should design their own innovation accounting system. However, we believe that every company, when they design their innovation accounting system, they should consider these 5 principles. First principle is that innovation accounting system should be a language that is spoken by the entire organization, not just one department, one lab, one team, but everybody in the company. Why? Because at one point you need to cross-pollinate. Why? Because at one point you need to be able to move one team from one department to the other. Well, everybody needs to speak the same language. The second most important principle, and this actually comes from software development. I'm an engineer by trade, is the abstraction principle. Abstraction means that whatever a team is measuring and producing in terms of measurements should be communicated all the way to the board. However, not at that granular level. So they need to abstract some of their indicators so that an executive can make sense. You cannot expect an executive to be interested in a certain velocity of an agile team. However, if we abstract that velocity to time to market, for example, then that particular thing becomes an important measure that an executive can look at. The third principle is that the innovation accounting system should help you improve your company's ecosystem. So it should help you improve capability. Well, we just realized by looking at the numbers that more people require this type of training, or we looked at the numbers and we realized that we have some waste in our go-to-market strategy, or we have some waste in our development, product development processes, or so on and so forth. The fourth principle shows the specific use of firms' growth assets. So here we're also looking at culture. We're basically saying, okay, how is a company deploying a certain asset, and how is that working for them? How is the product development process work, or the product lifecycle, or the innovation framework working? Is that yielding the right results, or the results we are looking for, or can we improve that? And lastly, it shows the risk of disruption. So this is very important. The innovation accounting system should paint a picture for the executives with respect to risk of disruption. So here we're looking at where were investments made, how do we have our portfolio distribution, all of these things. And obviously I will tell you more about it in the following slide. The other thing I want to share with you before we actually jump into clear indicators for every layer, remember those 3 layers I presented earlier, I want to make a distinction between key performance indicators and key results indicators. A lot of people tend to use the KPI word as a one-size-fits-all word, as a synonym for everything. Actually, there is a big difference between KPIs and KRIs. KPIs refer to the process and they can be influenced by management. KRIs refer to results and they cannot be influenced. You cannot influence, for example, the revenue from a certain product. What you can influence the process the team is using in order to get to revenue. You can influence marketing campaigns. You can obviously influence the process itself. You can influence strategy. You can influence a lot of things. However, you cannot influence revenue. Revenue is a result of a process. So it's very important to make this distinction and make the connection between the performance indicators and the results indicators. My entire slides following this are going to be structured on key performance indicators and key result indicators on those three layers I just described earlier. So we can start with how do we measure teams. You see here we're at the bottom of the pyramid. We're talking about how do we measure teams. Well, the KPIs for teams usually depend on the maturity of the idea. If an idea is early stage, where an idea is later stage, it's in scale or whatever, the indicators need to differ. Take, for example, an indicator which I like. It's a very easy one. How many interviews have you performed with clients, right? This is a good indicator of a team going and validating the ideas. It's a good indicator of the team honoring the iterative development process. However, this is an indicator that only applies in an effective way for early stage ideas. If you are at scale, how many people you've spoken to is no longer a relevant question, so that question should not be asked. This is why I say that it needs to depend on the maturity of the idea. And for you to have an innovation accounting system working in your company, you should probably look at creating a product lifecycle first, and then connecting the stages with certain key success factors and key questions and key indicators, obviously, for each stage. Another good indicator I like looking at, especially for early to mid stage maturity, is the learning velocity and experimental learning ratio. So how many assumptions have you validated in the past month or in the past week? What have you learned? Essentially, what have you learned is a better question. We've learned X, Y, Z. These are our learnings. Okay, how many learnings did you got in the past week? I got 5 or I got 1. And then you look at how many experiments were performed, and then you're able to accumulate the two and say, okay, if you're performing more experiments that you get learning, you probably are not very good at designing experiments. So we as managers believe that your team should undergo some training in that field. As things progress, as the idea matures, you can start looking at, for example, the AAR metric system, so acquisition, activation, referral, and revenue type of indicators, conversion rates. You can look at cart sizes if you're doing e-commerce. Essentially, all these indicators have to be connected on one hand with the business model that you're using, and on the other hand with the maturity level. Now, in terms of measuring teams, the result indicators, obviously, again, they depend on the maturity of the team. At later stages, when you're at scale, obviously you're looking at impact, probably financial or otherwise, but for most organizations, financial impact is a good result indicator. But for earlier stage, you're looking at something that we call confidence. Confidence that the idea can make it to the next maturity level. Confidence that, yes, the team is on the right path to move to the next maturity level. So initially at early stage, they're reporting learnings. The result is confidence. They move to the next stage where they're reporting other things, but the results are probably financial or impact or God knows whatever you need the team to do. Again, it's depending on the business model of the team. Moving on to the next, yeah?
I have a question. How do you define confidence? How do you decide on confidence? Who decides it? Is it the team itself? Is it the management? Is it a combination? What is your experience?
For this to work, a company needs to come together and put together a thing called a venture board. Internal venture boards act exactly like VCs do in the startup world. So they look at their portfolio and they start investing. Initially, early stage, they invest time, meaning that they allow teams to, hey, go and perform interviews. I allow you every Friday for the next 2 months to just work on this idea. Later stage, they start investing also money. Hey, you probably need to have access to a 3D printer, or you need some developers, and so on and so forth. The confidence is given by this thing called the venture board. The venture board is made up of managers in the company or in that particular department, and they need to meet with the ventures on a constant basis. Like VC investors meet with the startups on a constant basis, the venture board needs to meet with the teams on a constant basis, and they need to take decisions on a constant basis. And the decisions are pretty simple. You can either progress the idea to the next stage, keep it there, have it, learn more, or stopping the idea. And every meeting, you are actually going to go to your Excel sheet or whatever you're having, a PowerPoint, and rank the confidence in that particular team. And once the confidence amounts to a certain value, you need to design that upfront in your company. You can say, okay, we're confident enough that this team has validated the let's say the desirability aspect of their business model. Perfect. We can just move them to the next stage of the product lifecycle, and here is where they will have to validate now the feasibility of the idea or the viability of the idea, and then they have to perform other type of experiments, probably at scale, probably different. I hope this makes sense, John.
Yeah, no, I wanted to hear that clarity. We used to have 90-day plans at P&G where we had the teams coming in, and indeed we would look at in a certain way at confidence. We didn't describe it in this way, but that's exactly it's consistent. All right, why don't we move on? We got 5 minutes left.
We're on time.
Yeah.
I would say that 90 days intervals, by the way, it's a bit too long given how fast the market is moving now. But I think every company should design their own time frame. Okay, and if it was 10 years ago, then I'm sure P&G is doing way better now. Yeah. Anyways, moving on to the next layer. So now we're looking at the venture board. And we're looking at what are some indicators that people should focus on when they're part of the governance layer, when they are the venture board. Essentially, in terms of process, you look at the standard deviation of value for certain for all the ventures that you have in your portfolio, and you're looking at the weighted value to cost ratio. So you're looking at how much was invested, what's the next investment milestone, what is the value, what is the potential value that this venture can bring. As a result, result indicator, you're looking holistically at your pipeline. So you're looking at the percentage of ideas progress from one stage to the other. You're looking at the average cost per maturity stage. So on average, it costs us, let's say, 1 million for a company to achieve this maturity stage. What is that telling us? Well, it really depends how we performed last year or how our competitors are performing, depending if we have the numbers. Estimated likelihood of progression to the next stage. This is very much connected with the confidence we discussed earlier about. So these are all happening at the venture board level. There are many companies out there that are doing a great job on this one, and I think if you're interested, I think you should look at, for example, what Telefonica is doing in Spain. I'm a big fan of how they are measuring their pipeline, and actually we're going to feature them in the innovation accounting book. Moving on to the last layer.
Then allow me one question on this one, and I know I push you a bit on time, but I still have a question on this. In this morning session where we talked about metrics with my innovation council, somebody brought up the word risk. Where would risk fit in? I mean, that should also be part of the KPIs, I presume.
It is the estimated likelihood to progress to the next level. This is the risk. So basically, if you're looking at a venture, you say the estimated likelihood to move to the next level is 10%. It means that you have a 90% risk that they won't make the next level. So risk is embedded in this. Risk is embedded in your confidence intervals that I showed earlier. You say, okay, I believe 20% chance that they validated the desirability of their ventures. It means that you have an 80% risk that people don't want that particular product or they don't want that particular service. So it's implemented there, but it's in reverse. I talk about it in reverse, in positive. So how likely is a venture to progress, not how likely it is not to progress. But it's the same thing, essentially.
Okay, cool.
The next layer, so then the top layer, again, we're almost done with the deck. We're looking at what are executives needing. So in terms of the process, they're looking at a portfolio distribution, I would say, essentially, because they want to understand where they need to make more investments. They need to make more investments in transformational ideas, in core ideas, in adjacent ideas. How should that investment look like? Obviously, they are very interested. And again, through our transformational work, we realize that executives are very interested in this particular key result indicator, cost of innovation. How much are we spending on innovation on any given month or any given quarter or any given year? Because this is going to influence our decision moving forward. Should we invest more? Should we invest less? How should that look like? Then you're looking at the innovation sales rate. Essentially, this is how much sales do we get from ideas that we launched in the past year or in the past quarter. New revenue, obviously, how much new revenue is being generated by these new ideas. And then risk-adjusted potential revenue of the portfolio. John, to your point, you are basically looking here at the overall portfolio. What is their estimate revenue for every stage, and then you're multiplying that by the confidence. And you are basically getting a risk-adjusted view of your entire portfolio. So let's say you have a $1 million venture. It's a small one, but it's an easy number to compute. If we believe that the confidence is 30% because they've only validated probably desirability, I would say that the actual risk-adjusted potential revenue from that venture is 30% times 1 million, so it's 300,000. If the idea progresses and it reaches that, let's say, 70 to 90% confidence, then all of a sudden the risk-adjusted revenue from that venture becomes close to their estimate of 1 million. I hope this made sense. But essentially, these are the indicators for the executives, for the people that stay at the very top of the organization. They don't need to know the nitty-gritty of a venture. However, they need to have an aggregated view of what's happening in the overall ecosystem. Benefits of having an innovation accounting system. Obviously, it's a way to take data-based or data-driven decisions regarding your innovation ecosystem. You can finally track the cost and the impact of innovation in your company, so you're no longer investing at random. You are just investing based on evidence. And very importantly, you get input regarding the intangibles, and you get early feedback on your innovation strategy. Because again, what I just said earlier, financial results only tell us about what has happened, and it usually takes 6 months to 1 year, maybe 2 years to actually get the results from the market on your particular strategic initiative. Through innovation accounting, you can learn if that particular strategic initiative or a group of strategic initiatives are going to yield results in the future, because you're looking at confidence, you're looking at how they de-risked over time. We are actually, as I said, writing a new book called Innovation Accounting. You can go to innovationaccountingbook.com. You can sign up there. You can find out more about our progress. These are my takeaways that I would recommend from my talk. Basically, innovation accounting is more than just measuring a team or a single part of the organization. You have to have a system that's looking holistically at your company. You can't talk about innovation accounting if your organization is not mature enough innovation-wise. So you can't talk about implementing innovation accounting if your company only is doing innovation in a lab and you're only investing in 5 ideas per year. Innovation accounting is just going to be an overkill for you. Managers can't influence results. They can only influence the process. Again, this goes back to the conversation we had regarding KPIs versus KRIs. And lastly, we change what we measure, so let's measure what we value, meaning that we need to connect our innovation accounting system to our overall value creation system. And I'm not looking only at the value creation system as a form of creating value in ventures, but I'm also looking at the company's culture. I'm also looking at a company's, let's say, corporate responsibility programs. I'm looking at the overall impact that the company wants to have in the society. I think this was it from my side. Thank you very much. I'm looking forward to answering some of the questions.
So Dan, thank you for this. I mean, every time I talk metrics, everybody wants to talk metrics, but it's one big black box. And you have created some structure in here. So thank you so much. You've given a few thought starters, and I'm sure that many of us will want to go and buy a book to go and get more definition into each of the levels. But at least you've given us a handle to go and work around and work with. So thank you for that. Antonio Requiza wants to push this confidence point that I already made a bit harder. He said there's a great level of subjectivity in there. Is there any way that you can go and make it more analytical? Have you been thinking about this?
This is something we've been working on or thinking about for, I would say, the past 2 or 3 years. However, we are not, I can tell you in full honesty, we don't believe we are smart enough to solve this. What we have seen work in most of the cases is that it comes with practice. So those venture board members need to have that practical experience of looking at ventures and measuring their confidence. Again, comes with practice, comes with training. There is no substitute for hands-on experience. What we've seen work very well is that on that particular venture board, in particular for early stage venture boards, by early stage venture boards, I mean companies that are just getting started with the venture board process. What I'm seeing work very well, and here I can give you an example of a bank in the Netherlands that's been doing this for I think 3-4 years now, is to have an external VC sitting on that venture board. And the managers will look at that VC and how he ranks the ventures, and they will learn on the job. Essentially, it's going to be on the job training. There is no way you can do it in a scientific way or in a quantitative way. It's very subjective. You are right. This is why we encourage the venture boards to be diverse, not just one person, and we encourage to cross-pollinate, not to have only people from one department, but from many departments. And what I just told you, have people from outside the company with experience sitting on venture boards. I'm sitting on a couple of venture boards in some of my clients. And my role is exactly that, to look at the ventures in a very laid back way, not being particularly involved in the company, not being involved in the politics in the company, and give my opinion of, hey, I think this is good, the evidence is good, I am going to evaluate it like this. And then I showed it to the venture board, and then they'd be like, okay, yeah, we evaluated the same or not really, and then we discuss why they evaluate differently than they did. With time, things are going to get better.
I mean, it's not very objective, but I like the point that you make. You cannot really make this objective. But I always used to say you need to make sure that you maximize experience meeting knowledge. Knowledge of the team meets experience of the decision makers. Bringing diversity in, as you said, so that you don't get groupthink. And I love your thought on bringing somebody from the outside into this. This is really cool. Thomas Canova, any insights on how to include, measure the strategic benefit of a choice/project for a company beyond the financial value of the project?
Yeah, right. It's a very good question. So this goes in the direction of measuring impact, I believe. And it's very difficult to answer this if we don't know a specific case. For example, we were working with a bank in Norway, and one of their KPIs KRIs was a result indicator. One of the key result indicators for some teams was brand recognition, and it was NPS, so Net Promoter Score. Basically, they were looking at the customer satisfaction scores. again, I think it's very case by case, and I think that your company should have that conversation internally and say, okay, this is how we measure the benefit of a project beyond financial. We are looking at NPS, or we're looking at brand recognition, or we're looking at recommendations, right? What is the virality index of our brand? Again, it's very difficult to give you an answer to this question. If you want to reach out to me on social media, we can have this conversation one-on-one.
That's good. I think you gave two specific examples of non-financial metrics. And by the way, the one that the one that you gave about brand recognition is straight back to where we started with Jim's point, right? But the power and importance of brand as well as of innovation. Hey, time's up. It's exactly the hour. Jim and Dan, thank you so much for having contributed to what I think was a very rich session. Please, everyone online, can you please make sure that you fill in the feedback? We want to go and learn and improve. I hope you've enjoyed it. Any comments you want to make as follow-up, very welcome. Thank you for having invested your time. I hope you found it worthwhile. Again, Jim and Dan, thank you so much. Thanks, Derek, for organizing this thing. And join the conference board for any next experience. I will see you soon again.
Thank you very much.
Thank you, everybody.